optimistic about the prospects for the European economy. We don't expect strong growth, but we do expect to see some growth, and we're certainly confident that we're going to avoid a recession as well. So it's an environment that's not too strong, but we think is going to be okay and will support corporate earnings. Somewhere between 0 and 1% probably in 2024, maybe strengthening a little bit more into 25, maybe up to 1.5%. So it's not going to be super strong, but it's going to avoid recession. It's going to provide some support for companies and earnings, and we think that's a pretty solid backdrop for European earnings. We think that European rate cuts potentially could be very supportive for European equities. It's looking less and less likely that we're going to see interest rate cuts in 2024 in the United States. If we do start to see rate cuts in Europe, and it looks like we will do in June and potentially in July, and we've already seen some in Sweden and in Switzerland, then that could, I think, be quite attractive for European assets. If we have declining discount rates and that stable economy that I talked about earlier, then that's going to be a good combination for both earnings and the valuation on which companies trade. And so we think potentially that could be a very positive scenario for European equities. Well, I think it's an interesting period. We've seen that in the first part of this year, where it's not been so much about style as about earnings growth. So you can make money in European banks or in European technology in 2024. And we think that that's likely to continue. You know, with real rates around the 2% level in a US or global context, you know, it's unlikely that that's going to change too much. And therefore, it's all going to really be about earnings growth. That's going to be the key element. And so it's the companies which can deliver sustainable and sustained earnings growth, not just in 24, but into 25 and beyond, that we think are the places that are going to do best. We see opportunities across different sectors, but particularly in technology, in industrials, within financials, also selectively within consumer discretionary and healthcare as well. So lots of opportunities out there, and we think that the prospects for earnings look pretty good. Well, we're always looking for really high quality companies, so we're very selective, very picky. We're thinking about perhaps 100 companies in Europe out of maybe more than 1,000 that meet our criteria. So we're looking for high quality companies, strong business models, attractive industries with good rates of return, strong balance sheets, good cash flow, good management teams, strong ESG. Where we can find all of that in one company, then it enters our criteria. That's the type of business which we're looking for. And then we've got to find valuation. We've got to find prices that can imply attractive long-term returns. And when we can put that together, it allows us to build a portfolio of 25 to 30 world-class companies with really attractive returns. And that's what we're looking for. Europe doesn't have loads of those companies, but it's got enough for us to build a very good portfolio. Yeah, absolutely. So one company, it's not listed in Spain, but it is a Spanish company, would be Allfunds that we own within our portfolio. And that's a company which has had a tougher time over recent couple of years. Investors have been putting their money in cash and money market funds, not investing in bonds and equities. We think that's starting to turn. They're being supported by higher equity markets. They've got some really interesting things going on in terms of the penetration of subscriptions within their business model. And ultimately, it's also a fragmented industry which has lots of opportunity for acquisitions and taking on additional contracts. So we're really quite positive on the prospects for Allfunds. It's not a particularly expensive stock as well. And we see some really good earnings momentum starting to come through within the company. So I think that's an example of effectively a Spanish company, even though it's listed in the Netherlands, which has got some great potential and which is not particularly expensive as well. I think the main risk is that we see a major resurgence in inflation that forces interest rates higher, real rates higher. I think that's the combination which we saw in 2022, which was very unhelpful for our investment strategy, particularly if we see soaring commodity prices, rising interest rates, higher bond yields. That's not good for our particular approach, and I suspect it wouldn't be good for the markets either. That wouldn't be our central case, but we do see some inflationary pressures out there. We see the copper price rising. There are various agricultural commodities that are under pressure. And of course, we see geopolitical developments in the Ukraine and in Israel and the Middle East, which we have to keep an eye on. But at the moment, our central scenario is pretty much a positive one. Steady growth, interest rates likely to fall. That's going to be supportive for investors into Europe, and we see the prospects for European companies, particularly the high quality ones, looking pretty good. So overall, we're actually pretty optimistic.